Welcome to the Artisan Podcast, where we share insights from some of the world's leading minds. Today, we review real estate tax planning strategies with Nadia Rusak. Nadia is a longtime friend and one of Canada's top tax lawyers. She spent over a decade at best-in-class law firms Stikeman, Elliott, and Osler Hoskin. She now plies her trade at Cragmore, a boutique international law firm. In her spare time, she helped write the current Canadian tax code and lectures regularly at McGill Law School. Please join me in welcoming Nadia. I didn't think I'd ever say this, but I'm getting quite excited about tax law. So without further ado, now, the reason why we're having this chat today is a few months back, I called Nadia to get her insights on the new capital gains tax legislation. So Nadia, maybe begin by telling us what are the major implications of the new legislation and what are the best strategies to minimize its impact?
Thank you, Joseph, for the warm welcome, and I'm very, very happy to be here. So, as many of our listeners might be aware, on June 24th, a new law came into force that basically raised the capital gains tax from what used to be 25% to approximately 35% at a top marginal rate. That means that realizing capital gains has become all that much more expensive. And us as tax lawyers have now the obligation and the privilege to serve our clients in order to develop tax plans in order to minimize or potentially maybe even avoid the realization of capital gains and the increased capital gains tax. Now, of course, in this modified landscape, it is more difficult to do tax planning. And most of the planning currently relies on taking advantage of various exemptions that are currently embedded in the law. Those exemptions might include a capital gains exemption on disposition of private company shares. They might include principal residence exemption. They might include various structures that allow the deferral of capital gains tax until death and potentially beyond death, and also various strategies that allow to transfer the growth or capital gains onto the future generation at a reduced or potentially at a zero tax rate. So I'm sure we're going to cover most of these strategies as we go. However, it is important to note that each strategy really depends on the type of asset we hold. And I think the presentation today, because of the time limitations and also because we want to bring you a focused perspective, will focus on real estate.
What's near and dear to a lot of our clients' hearts is the family cottage and various secondary residences, both in Canada and internationally. So maybe you can tell us the strategies and implications for secondary residences.
Of course. Secondary residence is a very, very common asset that families own. And under the Canadian rules, you cannot claim an exemption when you sell a secondary residence. Generally speaking, a sale would be subject to a capital gains tax. However, there is certain arbitrage we can do using the principal residence exemption. For example, and many people perhaps do not fully know the technical aspect of these rules, but under the principal residence exemption rules, you're not obligated to just claim a principal residence exemption on one property. You might be able to claim a principal residence exemption on several properties for different years. For example, if you own a cottage and a city house, you might be able to, at the time that you are ready to sell one of the properties, you might be able to evaluate which property has gone up more in value. And if, let's say, the cottage has been held for 20 years, and I assume let's doubled or tripled in value, and there's a significant capital gain involved, you might actually be interested in designating that asset as a principal residence exemption and not designate for those 20 years your city house in order to avoid taxation on a larger portion of the gain, assuming that the cottage has a larger gain. As planning becomes a little bit more complicated when it comes to foreign properties, such as, let's say, a typical asset would be, let's say, a Florida condo or a Florida house. You can claim a principal residence exemption on a foreign property. So the same strategy would generally apply. However, there's various issues associated with holding a Florida cottage in personal hands due to the U.S. estate taxes and probate issues that may arise on death. Therefore, most people create trusts, local U.S. trusts, in order to hold their Florida condo, Florida house. And the planning could be done in order to structure a particular trust in a way where a tax deferral would be obtained, meaning that the trust is not an individual, and especially if it's a US trust and it's properly structured as such, you might actually be able to fully avoid the Canadian tax. So, one of the elements of planning would involve structuring these foreign trusts that own secondary residences, let's say in the US, in order to actually make that trust a resident in the US and not a taxpayer in Canada, so that the Canadian tax becomes irrelevant. And if that is not possible, planning could be done in order for a trust to hold property that would then be that would then pass to the beneficiaries of the trust tax free under by taking advantage of Canadian tax-free rollout rules. Essentially, this is a strategy that would allow you to hold the property and take advantage of it, use it, live in it, while the family, let's say the principals of the family, the father and the mother, are alive, and on death to transfer that property to the children without additional tax. Again, trust is the primary vehicle, but the drafting of the trust and the structuring of the trust is where the complexity lies. And depending on a particular client and the type of the property and also the estate planning objectives, a trust has to be tailor-made in order to meet the objectives and minimize the tax.
In terms of the principal residence designation in Canada, or the creation of the trust for international property, can these things be backdated? So in other words, if our clients haven't enacted these various things, can they go back 10 or 20 years and say it's as of X date, or is it just from today going forward?
It would be very difficult to do. In some circumstances, it is possible to go back a few months, in a sense that when a person forms an intention to create a trust, and the circumstances are such that people involved in the trust, the trustees, the beneficiaries, the settlor, act in a manner as if the trust is really in place, except that it hasn't been drafted or set up, it is possible to go back in time. However, as of January 1, 2024, trusts have become subject to very extensive reporting and filing requirements. So it is generally not possible to go back, call it a year later, or even more, because you would be in default on your reporting and filing obligations, and that would either reveal a non-existence of the trust at the time, or subject the client to very significant penalties for not reporting, which we generally try to avoid.
So, I mean, a lot of our clients have trusts in various forms, and so outside of this, going forward for a potential international property, given the onerous reporting requirements, does it still make sense to have a trust or actually to create a new trust? Are there still uses of these things, or is it really that's yesterday's news?
Trusts can still be useful. Their use is more limited after the new legislation was passed. However, they're still useful. They can be useful most specifically to hold international properties because, as I mentioned, they may allow you either to avoid the Canadian tax or defer the Canadian tax when there's a transfer of international property within the family. So that could allow you to transfer that property within the family without paying any tax. And also they could be quite useful as death or estate planning vehicles because they allow you to transfer the potentially the future growth of your real estate that could be held in a trust directly or through an additional vehicle such as a corporation. They can allow you to transfer that additional growth to the next generation. So yes, trusts are rather useful. However, we used to use way back when trusts for income splitting, and we would bring in the kids and sprinkle income on them, and they would benefit from their tax brackets in order to basically minimize the overall tax on the income that comes from the underlying property. Currently, if I were to describe the kind of the use of the trust, it's really tax deferral and also transfer of the future growth of your real estate holdings or other assets that you might want to hold in the trust to the next generation. Uh, that is really the scope of the planning. There's another element which we'll talk about when we discuss the commercial real estate, is that you can actually use a trust in order to multiply a capital gains exemption on the sale of a real estate operation. However, that would require a set of very specific circumstances in order to take advantage of it. And I will touch on that point when we come to the discussion of the commercial real estate.
Okay, and something else that's near and dear to our clients' hearts is rental real estate and the potential for flipping with principal residence and implications of that. So, what are your thoughts on rental real estate and strategies there?
Right. Again, in tax planning, everything depends on the context. So let's say you have a rental property that you want. So let's say a family owns a rental property, a nice condo in downtown Toronto, and then the child grows up, starts going to university, and the family wants that condo to be used by a child. So there's a change of use from the rental property to the personal use. What can be done? Well, generally speaking, under the tax law, when you change use of a property, that causes an immediate disposition. And without any planning, you'd actually realize your capital, all of the accrued capital gains on that property right away, and you'd be subject to that increased capital gains tax. Instead, there's various tax elections, very specific tax elections that could be made uh, in connection with the change in use that would allow to avoid the realization of the capital gain. And basically, what happens is when that change in use occurs in the year in which it occurs, the owner of the property would make a designation in their tax return that would basically ask the government not to recognize the disposition and to defer the recognition of that gain that accrued up to the point of the change in use until the property is actually sold. So that realization is fully avoided and capital gain is fully avoided. Very few people are aware of it. A lot of the times you see these reassessments coming out from the CRA. Here you had a change in use. Here's your reassessment. Here's your capital gain. Oh, it's too late already to make an election because the 3-year time frame for the election has expired, and so on and so forth. So very important to contemporaneously with changing the use of the property to do that type of analysis, and obviously consult a tax professional.
Yeah, I mean, that brings up an interesting question to me, which would seem relevant to a lot of listeners. Um, so I understand if you have a residence and there was a luxury real estate broker that was asking this exact question, because he said a lot of his clients were renting out their houses. So we're talking $5,000 a month or more. Um, so that I understand. If you go from living there to renting, you during that period you can't use it as principal residence. But in the current world, life has become murkier because we have Airbnb. So I'm living in my house. I'm sure if I rent it for one day, I don't lose my principal capital gains exemption. So when do we cross the line? Because you could easily have somebody who's spending 6 months
Absolutely.
less a day in the United States, renting out their place for 6 months less a day. Can they keep their capital gains exemption on the Canadian property? Because if they're renting it out for that entire 6 months, they're probably making as much or more than a full year of rent. So, how does
Exactly.
it work in that world?
Yes, generally speaking, it's really a question of degree. The test for the principal residence, the technical test, is that the property has to be uh, inhibited, principally inhibited by the owner. What does it mean in inhabited? I apologize. Um, the property has to be principally inhabited by the owner. The word principally is obviously as a very malleable term. What does it mean? Is it more than 51% of the time? Is it 70% of the time, 80% of the time? And the way the case law, the courts and the CRA, the positions that the CRA took on the point is that as long as you're living there two-thirds of the time you have that condo available for use, and you've got all of your stuff in there, and your furniture and your clothing, and you can come back to that property anytime, and you have control ownership, full control ownership and use, and you can decide when you Airbnb it or not, that is still a principal residence. So I would, in your particular example, my analysis would be if you rent it for 3 months, and even if you make a killing with it, you should still be able to claim a principal residence exemption. It's really when you start creeping up of more than 1/3 of the time that the condo remains rented, you might be able to, well, you might be in a position to lose your principal residence exemption because the property is not going to be considered to be primarily inhabited by the owner. It will be deemed as primarily, not primarily, is no longer primarily inhabited.
Right, right. So snowbirds who are spending 6 months less a day in the US might not want to Airbnb their residence for that whole period. They might want to limit it to the 1/3 of a year.
You might want to do that, absolutely. And again, these are the types of issues that a lot of the times, I mean, with Airbnb they become much easier to establish because there's a paper record of what happens to the property. Now I'm familiar with a lot of clients who rent their properties to friends and family, and that obviously is something that could be done without sort of making it look like a commercial operation, and therefore your principal residence would be safer. It's really more the Airbnb commercial aspect to it that becomes more significant, that call it 3 months a year, that could throw you off. But generally, I think that if you want a rule of thumb, and again, everything is based on facts and circumstances. Perhaps a person that rents for 6 months could, in some circumstances, take a position that it's still a principal residence because the renting is sporadic, or the renting only happens when the person is out of town, and so on and so forth. However, I'd say as a rule of thumb, you should kind of look at it as a 3 months should be your limit. But it's a very, very, very interesting question because definitely a lot of people do offer their homes for rent, and even swap. There's a lot of there's a lot of services out there where large, beautiful cottages, beautiful luxury homes can be swapped or offered for rent, uh, sort of in consideration for you being able and to go and stay somewhere in Italy in a beautiful, luxurious villa owned by somebody else. So that is definitely something that happens all the time, and that should not generally taint your principal residence unless you do it to a significant degree, right?
So if you have any availability in your luxury Italian villa, just let me know. So I was maybe we can switch gears a little and focus on estate planning, which is also critical to our clientele, and maybe the uses and potential pitfalls with estate freezes.
All right. Well, this is a very, very interesting topic because, in my view, estate freezes have become even more interesting since the rise in the capital gains rates. Basically, what does an estate freeze allow you to do? An estate freeze allows you to take a property, and if we're talking about the real estate property, we would generally transfer that property into a corporation for the purposes of the freeze. So it allows you to take this property in a corporation, and it allows you to freeze the value of the property at a particular point in time so that the future growth of that property goes on to the children or the next generation, grandchildren. And the way this is generally achieved is through a series of steps where the person that owns the property transfers that property into a company in consideration for shares that have fixed value that cannot change in time. This is why it's called a freeze, because the type of shares we are using to the issuing to the owner are frozen in their value. The value will neither go up or down over time. And then the children or a family trust, and this is where the use of a family trust could become very interesting, would subscribe for new common shares so that all the future growth will accrue onto those new common shares. So if, let's say, you have a property that is worth today 5 million and you anticipate to hold that property for, call it, 20 years, the fixed value that the owner of the property, the principal, will receive will be 5 million trapped in those shares of a company. And then if the property, let's call it, I don't know, is worth 9 million, 10 years down the road, the additional 4 million that accrued over that period of time will now be held in the family trust. Or if we have adult children, we can issue shares and that growth directly to the children. But generally speaking, a trust is used because while the principal is alive, the principal generally tends to serve as the trustee of the trust and has full control over the shares, the growth shares that will ultimately go to the children. The principal has full control over the shares. So the use of a trust is not so much you would call it as not so much a mechanism that allows you to reduce tax. There's no reduction, and there's no real even deferral because children holding the shares directly would also provide you with a deferral. However, a family trust in this context gives a very important uh, 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 call it gives a very important provides a very important element for the principal is the control over the company and control over those shares that will eventually go to the children. And so if it's interesting why estate freezes are so popular and even more popular now is because when somebody passes away in Canada, you have what we call a death tax. Basically, all of your assets are deemed to have been sold at fair market value, gains get crystallized, and the person pays the tax at a capital gains rate. However, all of the value that is sitting in the family trust, that additional value that accumulates the growth, is not subject to tax. It's completely outside your estate. Therefore, if the principal individual were to pass away, the only value that would be subject to tax is the initial 5 million that we froze, and all the additional value that accrues after that point in time completely avoids taxation at the time of death. And the only tax that you will ever pay is when the property is actually sold or one of the children passes away, and so on and so forth. So estate freeze is very, very interesting. Uh, what I would like to add to that is that really there's additional benefits to these estate freezes in the context of commercial properties or properties that are run, even if they're not commercial, let's say they're residential, but that are run as a commercial operation. Because frequently what we tend to think about real estate as being a passive um, uh, income generating asset. Basically, you hold real estate, you collect the rent, and that's about it. And that is true in a lot of cases where people hold one, two, maybe three properties. However, when you've got a real estate empire, you've got multiple properties, all of a sudden you need a management company. All of a sudden, the principal is involved in the business, coordinating how the buildings get serviced. All of a sudden, children get involved, and all the family might be contributing in some form or shape to that real estate operation. And if at some point that starts looking like an active business, meaning that you've got employees, you've got a management company, you've got services being provided to different buildings, if you're in that realm of an active business, that's where the freezes become even more interesting, because if ever the company that owns that active real estate is sold, you can actually claim a principal residence exemption. And what happens when there is a principal holding frozen shares and also a family trust that has, let's say, three children as the beneficiaries? Well, what happens in those circumstances? What happens is that every single person in the system, the principal and each child, are able to claim their own principal residence exemption, which currently is 1,250,000. So in my example, you would have the principal and three children, and usually there's also a spouse in the mix. So let's say there's a spouse, so you've got five individuals that directly or indirectly own shares in that real estate company. The company gets sold. That might be a management company or a real estate company, depending on the structure. Everybody will be able to claim 1,250,000 of an exemption, and so multiply that by five. Basically, $6.5 million of capital gains go completely untaxed, go completely tax free. Very important to set up the structure at the outset, because you cannot, uh, you know, uh, uh, at the time that you are ready to sell, you cannot do the freeze immediately before you sell. Value has to accrue into the trust in order to actually be able to claim these capital gains exemptions for each beneficiary of the trust. However, if the structure is set up well in advance, generally that provides you with a significant tax saving.
Right. So the idea there is there has to be active operating income rather than passive, and so it's treated like any operating company where you can use a trust to multiply out the capital gains exemption many times. So the family house, no, but if you own 10 apartment buildings and you have an operating company, that's your business, then we can do some very interesting things from a tax planning perspective.
Absolutely, absolutely. And I would say that a lot of the people that own commercial real estate, this is a much easier test to meet. And frequently, when we talk about real estate, we don't think about principal residence, or excuse me, capital gains exemptions, because we somehow think of them as being applicable to some other private business. Real estate does qualify, and especially commercial real estate. However, you can structure even the residential rental real estate in a manner that by hiring employees, by having a management company, by providing services to the buildings, so that you actually do have an active operation and you can benefit from that exemption.
And can those employees be your family?
Absolutely.
Okay, so there's some interesting stuff. Maybe a whole new webcast just on that topic.
That would be a fascinating topic because there's a lot to be said about it.
Hmm. And a lot of value to be gained.
Absolutely. And what is interesting also, as the government came out with the increased rates on capital gains, they also came out with a parallel legislation that allows you to transfer intergenerationally a family owned business without tax. So basically, there's this whole new set of rules that have been passed. If dad, let's say dad owns an active business, it could be real estate in which the family members are employed, there's actually a structure to transfer that business to the children or grandchildren. And by the way, the word child is defined in the law much more expansively than the linear descendants. So it actually could be a niece or a nephew as well, or a niece of a nephew of a spouse that is a second spouse, and so on. It's a kind of the child and a grandchild is a very, very expansive category that generally covers actually much more than just a direct child and a grandchild. You can transfer that business to that one or several of those individuals by way of a trust or directly on a tax-free basis. And that could be done in anticipation somebody getting old, retiring, trying to pass the reins to control the business to their to the next generation. These are very complex plans. However, they provide a very significant benefit. And we can definitely have a webcast specifically on this topic. I can go through the rules in a very general manner. I wouldn't want to bore your audience with the technicalities because they're rather complex. But it is important to note that real estate does qualify for that type of intergenerational transfer, provided that the planning is done.
And just before we go, for our clients out west, any kind of thoughts on farmland and what can be done there?
Farmland is what we call is a very special category in tax law because farmland benefits from its own set of rules and its own exemptions. And there are two primary advantages of farmland. Number one, the sale of a farmland does allow you to claim an exemption of up to $1 million per person per owner when that farmland is disposed. And obviously, you need to qualify that farmland as farmland. And for income tax purposes, it is a farmland if it has been used as farmland for producing farming products, be that growing something on the farm, growing crops, or perhaps uh, uh, you know cattle or animals and stuff like that, but it has to be operated as a farm, but it doesn't have to be operated by the current owner. It can be operated by the parents of the owner or the spouse of the owner or the children of the owner. So it has to be an asset that at some point in time during a 2-year time frame was operated as a farm. So you might own a farm for 10 years, and if out of those 10 years, for 2 years out of 10, that was actually operated as a farm, you can sell the farmland and claim an exemption of $1 million per person. You also, what you can do is farmland qualifies for an tax-free intergenerational transfer, meaning that when the farmland passes to children or grandchildren, it can pass tax-free. So, as long as the children and grandchildren inherit the land, and as long as that test of active exploitation of a farmland for farming purposes, you can't just rent out the farm to somebody else. You actually have to, somebody in the family, and it doesn't have to be the owner, somebody in the family has to farm the land for at least 2 years. Then that gives you a golden status of a farmland for tax purposes, and it can be flipped from generation to generation tax free. Here, again, trusts are very interesting. If you want to concentrate the control over the farmland or an ownership of a farmland in a single vehicle, However, you want to have multiple owners. So a lot of times what you could do is either create a corporation or a trust, put the farmland in that vehicle, and then whenever you want to transfer that farmland to the next generation, it will be transferred through the trust. And people who are beneficiaries in the trust would each be deemed, even though it's in the trust, they're each deemed to be the owner. And on the sale of the land, each of them will claim an exemption, not just one person. So farmland, there's generous exemptions for farmland. However, in order for you to qualify in order for the land to qualify as a farmland for tax purposes, it does need to meet certain active exploitation farming requirements. So a lot of the times when my clients come to me and say, well, I have 100 acres of land and it's all beautiful fields and all that, I mean, we have to take a hard look as to whether that farmland has ever been used for farming. And if not, I would always advise my client to set up a farming operation for 2 years prior to sale in order to ensure that that exemption can be claimed. And generally speaking, that is not for a lot of people, it doesn't take a 10 employee type of farming operation to meet the test. One person can do the farming, as long as the income from the farming is the majority of the income that that person earns that would satisfy the criteria. Again, we can have a separate podcast specifically on farming, because obviously if there is a lot of value in a farm, a lot of families don't want to sell the farm. They want to keep the farm for the children and grandchildren. The family tends to live on a farm. And we think of a farm, as as maybe something more rural, but these days farms are absolutely stunning, beautiful properties with beautiful cottages on them, and it's a beautiful place to live. And it's important that that beautiful property passes to the next generation tax free, and there's certainly ways to achieve that.
Okay, so we have to start growing crops at the family cottage 2 years before we sell it.
In a simplistic summary,
I'm
yes.
just joking. I'm just joking.
Yeah.
So, Nadia, we've covered a lot of ground. Is there anything that we missed in terms of real estate tax planning strategies?
I think we have mentioned a lot of interesting points. We have talked about claiming a capital gains exemption on a real estate that could be structured as an active operation. We talked about the advantages of doing estate freezes in order to pass the growth of real estate to the next generation without paying the death tax. We talked about international properties. We talked about arbitraging the use of the principal residence exemption in order to make sure that we apply that exemption to the property that has a higher value and minimize the capital gains tax that way. And we also touched upon the advantages of doing intergenerational transfers for the active real estate holding and also for the farmland. And obviously, do not forget about the change in use. Every time you try to, change the use from principal residence to rental or do the Airbnb type of operation, always have to keep in mind that you might trigger a disposition on a change of use, and therefore you need to make certain tax elections. Ask your accountant or ask Nadia Rusak as to what kind of planning needs to be done in order to avoid the unintended consequences. And if you're doing Airbnb, really have to watch the time period. It's not really a question of profit, it's a question of time. How frequently, how often, and for how long do you rent your property? Always have to keep that 3 month limitation in mind to make sure that you still qualify for your principal residence. And if desired, we can have a separate webcast on each of these topics. They're fascinating, and we can go much more in detail on each of them.
Okay, so until then, thank you so much for your time, Nadia. If anyone has any follow-up questions, they can either contact either of us directly on LinkedIn or send an email through Northland or Cragmore. And so until next time.
Thank you very much for your attention.